Investing in dividend ETFs can be a great way to build and grow a consistent passive income stream. And some of my favorite dividend ETFs to invest in are covered call ETFs because they typically pay a monthly dividend, and it's nice getting that dividend paycheck a little more frequently. And the more popular covered call ETFs are some that you've probably heard of before, like JEPI, QYLD, and JEPQ. But there's been quite a few new derivative income ETFs that were introduced within the last year or so, and the one that I wanted to talk about today is called TSLY, that's currently paying about a 35% dividend yield with monthly distributions, and that's according to Seeking Alpha. And if you go onto the website, it currently has a distribution rate of 75%, which is pretty impressive, but you have to remember that the distribution rate includes both the dividend yield as well as the capital gains return. But again, still a really impressive overall return. So TSLY has its similarities when comparing it to other covered call ETFs, but the biggest difference is that it's only trading options and receiving the premiums from one stock rather than multiple holdings. And that one stock, of course, is Tesla. And this kind of sparks the debate of whether or not it's better to just hold shares of Tesla rather than investing into TSLY, but we'll get to that in just a minute. Its current net assets, or AUM, is around $324 million, with an expense ratio of 0.99%, which is definitely on the higher end, but it's the same for every one of the Yieldmax ETFs. According to its prospectus, the primary goal of TSLY is to generate monthly income by selling or writing call options on Tesla. TSLY pursues a strategy that aims to harvest compelling yields while retaining capped participation in the price gains of Tesla. So again, very similar strategy to a covered call ETF like JEPQ, but the option strategy is just slightly different. And then in very small letters here, it says that the fund does not invest directly into Tesla stock, which means that if you're invested in this fund and Tesla stock happens to rally, your gains won't be near as high as they would be if you were to just buy shares of Tesla. So you're definitely missing out on those potential capital gains, especially with how much Tesla stock price has completely skyrocketed this year. If we compare the two year-to-date returns, as you can see, Tesla stock has outperformed TSLY by about 60%, and that's including dividends too. But if you have been investing in TSLY this year, you still would have been getting some pretty nice dividend payouts. Probably the highest payouts I've seen out of really any dividend ETF. Since the beginning of this year, its average payout each month has been around 85 cents per share, with its highest being its most recent in July at $1.07 per share, and its lowest back in May at 44 cents per share. So this means if you were to have invested $100,000 into TSLY at the beginning of the year, you would have been paid around $5,000 a month just in dividend payments. But keep in mind that these dividend payments are variable and can change month to month, so those super high distributions may or may not continue going forward. If Tesla stock were to drop significantly, those distributions would get cut in half and potentially put you in the dividend trap. And that's definitely what we don't want. But with that being said, I did just recently purchase 2 shares of TSLY, so only about $30 worth, just to honestly see if it's something worth holding long term and adding more shares to along the way. So it's possible that I build up a small position in TSLY and update you guys later on that position and how it's been performing. And obviously with an ETF like this, it comes with no diversification since it's only focused on one stock, but there are similar Yieldmax ETFs in that same family like APLY that trades options on Apple stock, and NVDY that trades options on Nvidia, and a few others. So if you wanted to, you could own a few shares of each of these and have some diversification that way. But remember, each of these funds has an expense ratio of about 1%. As for me personally, I'd rather invest more into something like JEPQ, since it's a lot less volatile and trades those covered call options on more than just one position. But let me know in the comments below what you guys think of TSLY and whether or not it's worth it to invest in for those high monthly dividend payments. As always guys, thanks for watching and I'll catch you next time. See ya!